Bismillahirrahmanirrahim. This is the first video on forecasting financial statements. And in this video, we will explain how to forecast year-end cash balance from the average cash balance. We will also explain how to forecast year-end cash, cash and cash equivalent, short-term investments, accounts receivable, inventory, prepaid expenses and other current assets, and finally, how to project current and non-current deferred income tax assets. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with forecasting year-end cash balance from the average cash balance. Now suppose the company's annual sales is 12,167 and this will remain constant for the 5 years. The company holds 30 days of sales in cash. So the cash turnover rate is 30 days per, and we also assume that the cash balance at the beginning of the first year is 800. Now with this information, we can calculate the average cash balance, and the average cash balance is equal to the cash turnover rate, the average cash balance, the annual sales forecast, that is 12,167 divided by the number of days, that is 365, and we are going to multiply this by the days sales in cash, that is 30. So this will give us 1000. So the average cash balance for year number 1 is 1000, and this will remain the same for all the 5 years, as there is no change in the forecasted annual sales or in the days sales in cash. Now, to compute the year-end cash balance from the average cash balance, we will multiply the average by 2. So we have average cash balance of 1000. So 1000 times 2, and we are going to subtract this amount from the beginning cash balance, that is 800. So this will give us 1200. Now the beginning cash balance is 800 and the ending cash balance is 1200 for year number 1. And for year number 2, the projected year-end cash balance will be 800 and let us see the reason why. Now for year number 2, the beginning cash balance will be the ending cash balance of year number 1, and that is 1200. So once again, we have the average cash balance of 1000 times 2, and now the beginning cash balance is 1200. So this is equal to 800, and that is what we mean over here. And in the same way, we these are going to be alternate figures. ending will be the beginning, and this will be 1200. Now this becomes beginning, and that's how the things will be. Now we will project individual operating assets for Starbucks using a combination of forecast drivers, including common size percentages, growth rates, and assets turnover. Now, we are going to first of all going to determine the projected revenues for the next 5 years. Now, the total revenue for the year 2013, 14, and 15 is picked from the total net revenue that is given in the consolidated statements of the earnings, and we are going to look into the forecasting for year number 1, 2, 3, 4, and 5. Now the projected growth rates are given to us. So the projected net revenue for year number 1, this will be equal to the net sales for the year 2015, that is 19,162.7 times 1.131. So this will be equal to 21,673.01. 21,673.01. For year number 2, the forecasted net revenue will be 23,666.93, 26,293.96, 29,160, and finally 32,280.12. Next, let us project the cash and cash equivalents for Starbucks for the same period. Now the projected revenues now obviously these are for the year 2013, 14, and 15. They are from the consolidated statements of earnings, as you can see over here. And we have already projected the sales over here for year number 1, 2, 3, 4, and 5, and these values have just been copied from the previous slide. Next, the revenue per day will be, obviously we are going to divide this by 365. So the projected revenue for 2013 is 14,866.80 divided by 365 will give us 40.73, and we will repeat this for all the years. This will be 45.06, 52.50, 59.38, 64.84, 72.04, 79.89, and 88.44. We are assuming that the projected cash turnover is 30 for all the 5 years, and I would like to calculate the projected cash turnover for the year 2015. Now for the year 2015, the revenue per day was given per day was given as 52.50. Now the projected cash turnover is equal to 365 days divided by the projected revenue, or rather for the 2015 the actual revenue, that is 19,162.7. 162.70, and this will be divided by the average projected cash balance. Now, the cash balance over here is picked from the balance sheet. These are the cash balances. So we simply have the cash balance for 2014 1708.4 plus 1530.1, and because this is average we will divide by 2, and this is going to be equal to 30.84. that is what we have over here. Now the projected cash balance for year number 1 will be revenue per day 59.38 multiplied by the projected cash turnover in days, so that is 59.38 times 30, and this will be 1781.8. In the same way, we can project the cash and cash equivalent for year number 2, and that will be again 64.84 times 30, that is 1945.23. This will be 2161.15, 2396.71, and 2653.16. So that's how we are going to project the cash and cash equivalents for Starbucks for the next 5 years. And next we are going to project the short-term investments for Starbucks. Once again, the projected balance for Starbucks is given over here as 81.3, and that is simply we have picked from the balance sheet, and it is assumed that the growth rate will be 3% for all the 5 years. So the projected short-term investment for year number 1 will be the short-term investment balance for 2015, that is 81.30 times 3% increase growth, that is 1.03. So this will be 83.74. So for year number 1, the projected balance for short-term investment is 83.74, 86.25 for year 2, 88.84 for year 3, 91.5 for year 4, and 94.25 for year number 3. Next, let us see how to project the accounts receivables for the next 5 years for Starbucks. Once again, we can see the accounts receivable is given as 719 over here, and we simply pick up from the consolidated balance sheet for the year 2015, and that is 719. Now these growth rates are given to us. So the accounts receivable for year number 1 will be the accounts receivable for 2015, that is 719 times growth rate of 14.70, that makes 1.147, that is equal to 824.69. So for year number 1, the projected or the forecasted account receivable is 824.69. Year 2 will be 907.16. 1015.11, 1132.87, and 1262.01. Uh, Next, let us see how to project the inventories for Starbucks for the next 5 years. And first of all, I would like to go for now. Once again, the total revenue uh, is 19162.7, and the projected total revenue we have already calculated in the previous slide, so I have simply copied those values from there. Then the rate of change, and for the year say 2013, this is equal to cost of sales and occupancy cost, that is 6382.3 divided by the total revenue, that is 14866.8. So this is equal to 42.93%. So for 2013 it is 42.93%. For 2014 we calculate the same way, that will be 41.70%, and for uh, 2014 it is 40.64. These rate of change are given to us, so we have simply copied over here. And even the projected inventory turnover is assumed or is given to us as 56 days. Then we from this we are going to calculate the cost of sales and occupancy cost, and this is going to be 39.93% of 21673.01, and that is going to be equal to 8654.03. For year number 2, the cost of sales and occupancy rate will be 39.68 times 23666.93, and that will be equal to 9391.04. And we can calculate in the same way for others. This will be 10,336.16, 11,357.82, and 12,463.36. So that's how we calculate the cost of sales and occupancy cost, and that is how we have done it. Now we calculate the cost of sales per day. So cost of sales per day will be the cost of sales and occupancy cost divided by 365, that gives us 21.34 days, and sorry, 21.34 million. And then for in the same way for the year number 1, the forecasted will be the cost of sales and occupancy cost of 8654.03 divided by 365, that will give us 23.71. We will again divide 9391 by 365, that will give us 25.73. This will be 28.32, 31.12, and 34.15. Now once we have done that, we can now calculate the projected inventory balance. And projected inventory balance, before we go for that, I can emphasize that The 1306 is simply we pick up from the balance sheet for the year 2015. We don't forecast that, but for 2015 it will be the cost of sales per day, cost of sales per day times projected inventory turnover in days, that is 56. So for year number 1, this will be 23.71 times 56, and that is equal to how many days? That will be equal to, sorry, 1327.74, 1440.82, 1585.82, 1742.57, and 1912.19. So that's how we are going to project our inventories for the next 5 years. Next, let us project prepaid expenses and other current assets. Now, uh, for this, obviously, we need to know the company operated stores, and these are given to us, both the stores in the year 2014 and 15 and the forecasted company operated stores for year number 1, 2, 3, 4, and 5. uh, the growth rate is also given to us, for example, but we can calculate also, and um, the growth rate for, let me calculate for the year 2015. So this is equal to the company operated stores in the year 2015, that is 12,235 minus in the previous year 10,713 and divided by 10,713, that will give you 14.21%. So that's how we have here 14 point, this is the growth rate for the year 2014-15. For year number 1, we are assuming that it is given to us as 5.3%, 5%, 4.8%, 4.6%. These growth rates are given to us. Okay. Now we calculate the forecasted prepaid expenses and other current assets for year number 1, and that will be equal to prepaid expenses and other current assets for the year 2015, and this value of 334 is picked up from the consolidated balance sheet. So that is equal to 334.20 multiplied by this is going to be 5.3%, that is even 1.053, so that is 351.91, so that is 351.9, maybe 95, okay, 351.91 or 95, 369.71, 387.46, 405.22, and finally 422.97. So that's how we are going to forecast the prepaid expenses and the other current assets for the next 5 years. And finally, we are going to project current and non-current deferred income tax assets. Now, the current deferred income tax expense assets are given as 381.80, and even the Non-current, this is from the consolidated balance sheet 828.9. Now for simplicity, it is assumed that the current deferred tax assets will be fully realized in year number 1 and that the non-current deferred tax assets will decline by 10% per year or each year. Now this is the how the things will happen. So uh, the projected current and non-current deferred income tax assets for year number 1 will be will be 828.90 times 90% because it will decline by 10%, that is 746.01, and for year number 2 it is 671.41, 604.27, 543.84 and 489.46. So that's how we are going to forecast the current and non-current deferred income tax assets for Starbucks for the next 5 years. And this completes the first video on forecasting financial statements. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.